on DeFi market, crypto, everything that we're doing on Centaura. This time we're gonna try. We're gonna be talking about RWAs on DeFi, and we're gonna be trying a format that has been very popular. The I think 2-3 times that we have done it, in which we're gonna have a fireside conversation with. I invited two of our executives at Centaura, Katia and Lucas, who leads different divisions of our institutional DeFi platform, and we're gonna be having a pretty intense conversation about RWAs and DeFi. I know Katia and Lucas, if you guys want to do a quick intro about your background and what you do at Centaur.
Sure, happy to. My name is Katya. I lead the sales and partnerships team at Centaura, and I've been working in the crypto space for the last 6 years. I started my career working at Maple Finance back when they were doing under collateralized lending, and have worked across a number of DeFi platforms like Aave, Polygon, and most recently was the head of growth at Wormhole. So I've worked across the DeFi infrastructure, the blockchain infrastructure, and now more financial services space.
And from my side, I lead the institutional DeFi here at Centaura, basically launching and operating our vaults. I've been at the team since it was into the block since 2019, starting the research team, leading that, and now transitioned more towards operating along with coordination with the research, sales, and engineering teams.
All right, so before we start real quick, we always take a minute to give some updates from Centaura. We have quite a few. This week, the payroll company, expanded their Earn program that Katia architected, powered by Centaura, to 80 countries. Very, very focused on Latin America. This is a huge deal because it's one of the biggest payroll providers in the world, not necessarily a crypto company, that decided to launch their Earn program with Centaura a few months ago and now expanded it to 80 countries. Also, one of our RWA vaults that I think is probably a marquee RWA vault in the market that we created with Fingerprint surpassed 200 million in deposits. We also launched another RWA that is quickly catching up, MWIN, in partnership with Midas. And a few days ago, we pushed a new release of our Centaura Smart Yield platforms. I'm just going to show this quickly here. If you go to vaults.centaura.com, you can find vaults aggregating to 2.2 billion in assets. You can interact with it, monitor the risk, deploy directly from your wallet or your custody platform, all completely self-service, all without interacting from anybody from Centaura. And these are many of the same vaults are being used by some of our marquee institutional customers like Kraken, Crypto.com, and others. So this is, essentially you have the access to the same type of vaults that all those large companies have. Over the next few weeks, you're going to see some major releases from us, including some major news from our insurance subsidiary, Farlight. But I'll leave that for the next webinar. So for today's topic, we want to talk about something that is pretty hot in the market, something that we spend a lot of time thinking about it and doing work, that is the intersection of RWAs and DeFi. And the rules of the Fireside chat is I'll try to get Katia and Lucas to argue about each question. They argue every single day, so this shouldn't be very hard. If not, I'll force the argument. And we're gonna be discussing some very controversial topics, some of the same things that we spend a lot of time debating internally, but hopefully will bring some unique perspectives into how this intersection truly works. So let me start with a more generic question. So there have been numerous attempts to bridge a gap between RWA and DeFi. So there was Aave tried this with Arc at the beginning. They iterated with Horizon. Securitize famously announced their blockchain with Athena that converged that never took off or launched. There have been multiple chains optimized for RWAs. None of them seem to have really worked. Maybe Horizon is an exception to the rule. And at the same time, it's just hard to envision a future of DeFi without RWAs. So how do you guys see that? Katia, let's start with you. So what is the role of RWAs in the future of DeFi? And if it's so important, why nothing seems to have worked so far?
It's a great question, and one I think that the industry is still trying to solve. I think historically, when we saw a lot of these experiments with issuing RWAs on chain, the assets themselves have been heavily permissioned and have been gated to exclusively accredited investors or institutional partners who all were holding those assets off chain and were already not familiar with blockchain infrastructure. So you've brought an asset to the public blockchain that, you know, these players who can access it aren't trading on that venue. And so we kind of had a friction point where the average DeFi user had no interest and no way to access these assets. And what we're starting to see today is more of a translation into more permissionless assets and assets that meet the liquidity and trading requirements to be viable on chain. The role of RWAs in DeFi today is, I mean, it leads to a kind of broader question around the role of like DeFi today. I think the DeFi ecosystem has evolved pretty aggressively in the last few years. We moved away from a lot of these inflationary tokens and a lot of these creative DeFi systems to help create artificial demand for crypto. And now I think the role of RWAs is to pass on and introduce new venues for like utility for stablecoins on the public blockchain. So I think as the stablecoin infrastructure has evolved, as the way that these real world assets have been tokenized on chain has evolved, we're starting to get set up for a more robust RWA ecosystem.
So Lucas, is that to say that, so two side questions are most RWA just museum pieces that they don't really serve a purpose in programmable finance? And to Katia's point, for an RWA to actually work in DeFi, does it have to be permissionless, or there is still this stream of permission RWAs? So do those really work?
Yeah, I would say the initial version of RWAs that we saw was a bit of that, where there was very little added value from blockchain itself, and it would be just bridging an asset on chain effectively. But I do see the potential even for permissioned assets to get traction in DeFi. We're starting to see more of that, and MWin, which we launched with Wellington and Midas, is a good example of it, where I think in the bull market, yields in DeFi were already pretty attractive. So there was very little, competition that RWAs could bring to yields. Now that yields have compressed in DeFi, real world yields can scale a lot more and are often more attractive right now. So we're seeing looping take off even with permissioned assets, and I expect that to continue. So they're beginning to be ported more into DeFi, and I think it's expanding basically the portfolio of what DeFi funds would allocate to. And crypto natives are beginning to embrace a lot more real world assets, both like for the yields, but also for like just portfolio diversification. So I would expect that, to converge into like the V2, where we see a lot more integration between RWAs and DeFi versus just holding treasuries on chain on a wallet.
Katia, what do you feel strongly? Take the other side of that. Do you feel strongly that is permissionless is the only thing that works?
So yes and no. I think the reason why the Wellington asset works is because
No polite answers. No polite
no,
answers.
I mean,
Okay.
yeah, I think the reason why the Wellington asset works is because we worked with Wellington directly to construct the portfolio of MWin, and I think because it's a new asset that's on chain, there's some intrinsic value to investing in that. That I think institutions who meet all of the requirements are willing to meet. Like those players are willing to interact with MWin and go through the painful process of looping it or setting up accounts on chain. But I do think for the vast majority of traction in this space, like permissionless assets is where we've seen the most amount of growth. It's where we see the most amount of demand. And I think it is like, I think the reason why a lot of these permission assets in the past haven't worked is if you're going to be tokenizing a money market fund and I'm an accredited investor, I'd rather just go to my brokerage and buy them outright versus paying a tokenization agent an additional fee to access the same asset on chain. So I think like the permissioned assets, though there will always be subsidiaries and like small pockets of assets that I think are going to want to be on chain. Whether they need to be on chain is a bigger question. But I think like what's going to really explode in this ecosystem is going to continue to be the permissionless access of permissionless assets.
So I want to double click on that. Could you guys describe? So you mentioned MWin. So one of the things that that is becoming very obvious to us is most RWAs are not ready for DeFi. So it's not tokenization, it doesn't make you DeFi ready. And I think this is a misconception in the market. Could you guys outline like, what are the steps? Let's start with you, Katia. What are the steps that we need? What are the building blocks for an asset to be DeFi ready? And I do have a follow-on question there that is whether permission collateral plus permissionless liquidity is the right combination to make that work.
That's a great question too, and it's something that we're thinking about internally as well. I think to the first point around the steps, I think the asset has to be, in my view, the asset has to be novel. Tokenizing something like an existing asset that's been trading in TradFi for a very long time, admittedly, I don't think has a place in DeFi right now. I think we need to see sufficient enough liquidity, easy on and off ramps, and then we need to be able to ensure that the asset, the full amount that gets tokenized and minted on chain can be unwound in a timely manner. If not, then all of these DeFi use cases of borrowing against the asset or looping it isn't viable. A lot of the reason why DeFi scales and has been able to grow so aggressively is because there's live pricing markets of Bitcoin. There's live price feeds. There's active trading. There's somebody who's going to always be able to facilitate liquidations in a gated environment. A lot of those requirements are not possible to meet. And then to your second question around whether permissioned collateral plus permissionless liquidity works, I think it's a good intermediary right now. I think the permissionless transfers that we've seen be really successful with Centrifuge, with some of the Midas assets, I think has been tremendously successful in being able to allow users to participate in looping and experiment with plugging those assets into DeFi rails. There is a dependency on some other third party, though, to facilitate the on and off ramping of the asset. And so you still have this dependence and hoping that there's SLAs in place to protect the users who are doing the trading. And so that dependence is, for the most part sorted, but I think there's still like a risk to be aware of in case, one of these market makers chooses not to rebalance and chooses not to unwind their positions.
Lucas, what building blocks do we need to make an RWA DeFi ready?
One that we're seeing many projects come up with is one that solves the duration problem that Katya alluded to, whereby basically DeFi operates 24/7. You can't have 3-month lockups to unwind a position. So we're seeing a lot of players, I believe, Upshift, the Infinify, Redstone, and a few others are launching projects that effectively can liquidate those RWAs that have duration, add a fee, and give you like instant access to liquidity. So that should help expand, the amount of assets that are that have a longer duration for people that want longer duration, but still be able to add liquidity on it, since that really solves a lot of the pushback from curators on lending against long duration assets. So that's one building block that I think will unlock assets that struggled in V1 integrating into DeFi. Another building block is really just more integration into the real world economy. So we're working on this a lot, but basically being able to plug in with a brokerage or an exchange where you already hold your assets, such that you're not buying QQQ for the first time on chain, but instead just porting your existing holdings of stocks on chain to then access more utility on chain. So that bridge has been missing for like existing holders to move on chain, and it's something that we're very bullish about on building and what.
So let me see if I can illustrate the duration problem, because I think this is one of those things that there is a tremendous amount of ignorance in the market around this. Like almost trying to simplify it to stupid levels. So let's take an example that you take. I mean, something that we struggle with. So you have a token that an RWA that, let's say, represents a fund. The transfer could happen in a few seconds. The NAV settles once a day. The asset, the NAV update once a day. The asset settles on a T+1. But if you want to redeem the asset, it takes a week. Like, how do you reconcile? Like, when we architect this, how do you reconcile those different clocks?
Yeah, it's a good question, and I think ultimately depends on the access to liquidity. Because if you can, swap instantly or T+1, but at a mild cost, like a few bips, a lot of people will take that over having to wait a week to redeem fully for free. So I don't see them as at odds that much. It's more just about paying for urgency. So I expect that to continue, really, where you'll have like an instant access to liquidity for a cost, versus a bit of a gap to redeem for free. And I think that's healthy, frankly, and it's something that the tokenization agents themselves, the companies, will be able to use to, just make extra revenue for access.
So, Katya, one thing that you spend a lot of time working with issuers on the liquidity problem, on the liquidity profile. Can you explain how bad this is? Where are the gaps? And how should an RWA think about liquidity? Should be shared? Should be isolated? How should they think about the liquidity profile relative to the asset?
I think it depends heavily on the asset itself. I think an asset like that isn't planning on being leveraged in DeFi, I guess liquidity isn't really a problem. And for the most part, we see assets just getting minted and redeemed and just being held. We actually see that as a very popular use case for a lot of tokenized money market funds who are being held as collateral for stablecoins that are being issued. So that, I think, is a very popular use case, and liquidity is not a problem there. If you're hoping to get listed as collateral on a morpho market, liquidity is critical, right? Being able to facilitate liquidations is critical. We work with a number of parties to help ensure that liquidations can get processed, but on-chain liquidity is really important for these permissionless assets. I think Lucas has spent more time figuring out what that looks like for some of the assets that we've worked with, though.
Are you guys going to disagree on something at all, or going to completing each other's sentences? So let's talk about on the collateral use case. So these days, an opinion that I feel pretty strongly about, but it used to be heresy a couple of years ago, is that there is no point to RWS without DeFi. Like, I just don't think, what is the point of tokenizing something if you're not going to use DeFi rails? Like, I think it's completely useless. I'm happy to have that debate with anybody. Now, when you think about DeFi, there are two use cases that people like. One is used as collateral, and the other one is leverage. As much as people hate it, right? Everybody does the loops. Lucas, like, a lot of issuers believe that their RWA should be collaterals, and I think our research team published a long paper on this, basically saying, look, most RWAs are never going to be collateral. They don't have the profile. So what makes a good collateral? How should you think? How should in the context of RWAs think about loan to value ratios, redemption latency, like all these things to make a collateral in a lending protocol?
Yeah, it's a good question, and frankly, it has less to do with the asset being permissioned or permissionless, and rather just with the volatility of the asset and the severity of a tail risk event. So for private credit, for example, a lot of people treat interchangeably, and I think there's like an education gap in the industry. Like yield-bearing stablecoins and RWAs, they kind of converged in DeFi nomenclature, and so they treat like Athena, Maple the same way that they treat a Figure or Acrid, and that's just completely wrong.
Why?
Because
yeah,
ultimately the exposure you get to is very different, and then also the expected price of the asset for like a yield-bearing stablecoin is up only, as cliche as that has become, versus a private credit asset can be very volatile. We saw, Blue Owl and a lot of private credit funds either halt redemptions or some of them even close altogether. So the prices of those assets has gapped down like dramatically overnight, and that can happen in a market that's very illiquid. Like it can happen overnight if news happen throughout the weekend, and so you may have an event where you can't satisfy liquidations just because like over the weekend, a private credit fund blows up and there's no liquidity for people to like get out, and that leads to bad debt to lenders. So it has the LTVs that are set, and like the viability of an asset being a collateral has to do with that like gap down, sudden gap risk, where you can model all you want, like, the historical volatility, but if suddenly, the Fed hikes rate by a lot, that can lead to risks to the market. And that's a consideration that us as curators look into and affects, the LTVs, but also if we approve it as a collateral or not.
So, Katia, how should we think about leverage? Is leverage a good thing, a bad thing?
I mean, to Lucas's point though, if the asset price is, let's say you've entered a position on Sunday and it's a T+1 asset, and so you've taken a 4x loop and price is tanked, and now it takes you 3-4 days to get out of your position. It can be scary, right? I think not very few assets today, I think, have solved the duration window, the duration issue, to the point where that leverage trade can be executed safely. But that hasn't stopped people from taking on leverage. And so, I think as unglamorous as it is, users and like funds need to do a little bit more research on the assets they're holding and understand what the underlying looks like, and have a little bit more awareness of some of the risks associated with it. We've seen a lot of trades end up in negative carry, and it's difficult for funds to exit, and you can end up losing significantly more amount of money than you initially thought you could.
Yeah, I'll add something there, Jesus, that it's
disagree if you're going. I like leverage.
a little bit. So
the way we do it is great. So.
Spicy take, but leverage kind of makes it easier for RWAs to get battle tested because you can scale a lot more faster, and you can basically push the system to its limit faster
down to you're gonna scale down faster too.
Correct, 100%. But it's basically you're running the experiment at faster pace. Not saying you should go max long by any means, and curators and people participating should be cautious about this. But for just like testing that the pieces work as intended, it's a good way to get a sense of where the limits are and what the issues can be when they arise.
I don't like to see the limits though, right? If you're an institutional client, venturing into crypto for the first time, you're hearing that you can earn 20% on this leverage product, single click, super safe, issued by a massive TradFi entity. You end up in a bad debt situation, it ruins the legitimacy of the space, right? I'm past the point of wanting DeFi to be an experiment at this point.
I mean, I like leverage, but the way we do it, right? I think that if you try to loop RWAs without a sophisticated platform with proper risk management like Centaura, you're suicidal. Right? That is with the lessons that DeFi has taught us, it's good luck. So let's talk about that for a second. So risk management. So obviously, in the traditional crypto to crypto DeFi, it's all on chain and oracles. You have full visibility. Risk management has always been the hallmark of our platform for 5 years, but it's difficult. But at least everything is visible. Now, when you cross into that world, there is a lot of risk vectors that you're not seeing anymore. So where is the line? Like how do we think about risk management? What do we have? What level of visibility is key to make an RWA work in DeFi with leverage and the right liquidity profile? And what are the things that we just need to take a risk on?
Yeah, it's definitely complex, and it's why it takes us like 3 months plus to do diligence on an RWA. So a lot of it is the transparency and having visibility of everything that's off chain. Keeping track of the known unknowns, if you will, and being able to port that data on chain as much as you can. Oracle providers are making a lot of progress also in like getting more off-chain data on chain, which makes it easier for us to program not just alerts, but like rebalancing based on off-chain conditions. But I think we're in a bit of an in-between state right now where we need to do like custom architecture for each RWA, which is problematic on like being able to track, the whole portfolio of these either asset managers or, whichever RWA you're underwriting, which makes it complex. So that's why it's definitely worth erring on the side of like, getting as much data as you can and knowing what are the fallbacks and like having an incident planning in advance of like what could happen, because ultimately, as you say, Jesus, like these are just like two different worlds that we're trying to piece together, but they are not fully together yet. So there are in the interim some problems that we're sorting that need to be addressed, and I think we'll get a lot better over time.
Yeah.
Let me see if I can lead to a section that I think we're gonna spend a lot of time on. So when we started this journey with our WAs, the asset to tokenize was treasuries because yields in DeFi were really bad and all that. I mean, that took, I think, Beetle in some sense legitimized the RWA space. Then there was a wave of credit funds. We think we know how those are working out. And then there is this wave now with funds, like tokenized money market funds, on things like, to me, like just to anchor the polemic topic here, like that feels to me like wrappers upon trappers. So I'm fundamentally unsexy and not very innovative. Like, are those really the best things that we can tokenize right now? Is there a lot of value in tokenizing a fund, a money market fund at this point? Like we know from experience, making those work in DeFi is a royal pain. Liquidity, the settlement times are difficult. Like, what are the friction points?
I have a feeling you're leading into tokenized equities.
Yeah, that's why I want to go next.
Use case. I mean, I personally have always been really excited about tokenized equities. There's some restrictions in the way that the asset is.
Yeah, but can you answer the first question before
I know,
we go to the next question?
The friction points on, like friction points with tokenization today, is your question?
Yeah, credit, treasuries, money market funds, are those the thing to do now? Like,
I mean, the frustration is like, I alluded to it earlier. Like, it's just assets that exist in TradFi to a certain subset of qualified clients who can access them, being able to replicate their trade on chain. That's perfectly fine and acceptable, but I don't think it's particularly innovative. It's like two separate worlds that we've been trying to force into mixing. I think the next wave of tokenization is going to be focusing on assets that unlock new use cases and primitives to the everyday retail user. People who want to be able to access like financial services that their banks won't offer to them. And I think the use cases that we're going to be enabling with tokenized equities is a perfect example of that.
Lucas, to be more direct, like, for instance, tokenized credit, has that ever worked in DeFi?
It hasn't yet. That doesn't mean it won't eventually. I think part of it is the duration risk that we described and the lack of liquidity, which I think is being solved.
Yeah, that's an example of a product that was never DeFi ready. Like, has two massive blockers to be DeFi ready.
Correct. It was just porting an off-chain product on-chain, and it didn't have product market fit with like on-chain participants. So it's not fitting for the current DeFi ecosystem. But I foresee we'll get back to it once DeFi is robust enough that it's actually faster and cheaper to buy things on chain. But it might even require these to be issued natively on chain rather than just being the bridge version. So I think the custom, like more DeFi specific assets might do better short term because they can plug in and are a lot more aligned with the architecture within DeFi. And then private credit, I would imagine we get back to it in like 2030.
I mean, there is an incredible irony that we position this industry as the future of finance, and the assets that we decide to tokenize are the most boring, antiquated, archaic, full of friction point things to bring into that just don't work, right? And we spent 5 years doing that.
And we spent 5 years doing that. Just to tack onto that, like, we spent 5 years doing that, and we're trying to like retroactively build infrastructure that makes the blockchain look exactly like the traditional system. Like, what's the
when Lucas said when DeFi is robust enough, I think he meant when we invent TradFi in DeFi or something like that.
And then we moved away from crypto to just like blockchain execution.
Let's lead to tokenized equities, which I do think this is a sexy topic. So that is a space that we think it does have a tremendous potential at the intersection of tokenized equities and DeFi. So Katia, let's start with you. Like, why? What makes tokenized equities such a strong use case?
So recently, I think it was NASDAQ announced that they are going to allow an overnight trading session now. I think it's like 9 p.m. to 4 a.m. And I saw a tweet went out that was like, turns out we didn't need blockchain for 24/7 trading. We just need the servers to run all night. Like, and I think it is a very funny point. And initially when tokenized equities were coming online, people were excited about being able to trade in whatever time zone they wanted to, like whatever hours, but you still end up with like the pricing discrepancy overnight and some of the like price volatility that can happen after hours. I think the trading of equities is not as cool as we wanted it to be. I think what's really exciting is something that we've been working on for months now. But we worked on it with Ondo initially. Now we'll be rolling this out with some other equities partners. But the idea of generating yield on your equities, right? Mm-hmm. Or being able to borrow stablecoins against your positions, right? Your stocks that you own outright. I've got my own stock portfolio right now, and try as I might, I can't get any of my brokerages to allow me to borrow dollars against it. And that, I think, is just something that is a service that was originally reserved for really high net worth individuals. Now being able to make this publicly available, make this tradable, even if the assets are still permissioned, I think brings about a truly novel and in-demand use case for clients. There's still some components to solve in making that user experience more seamless, but that's a really practical use case that I'm excited to start to scale out over the coming months.
So Lucas, so on controversial opinion, right? So Katya's point is yield is probably the strongest use case for tokenized equities. Trading isn't. I actually agree with this. So I think perpetuals are a better product for trading tokenized equities, and yet a lot of the use cases that we're seeing in tokenized equities are trading. Hopefully we're going to break that in a few weeks with this big announcement that we have coming up. So do you think that's directionally correct? Do you disagree?
No, I tend to agree. I don't think it's that controversial. And I think like for holding spot, you might as well hold the non-tokenized version of the asset rather than the tokenized, which has less liquidity and a lot more friction to get it. So it's really about plugging into the existing DeFi ecosystem to either get leverage or yield on top of your assets. So that's really, that new use case that blockchain enables, and that really democratizes it, going back to the ethos of like Ethereum and crypto broadly. So I think that's really the unlock for tokenized equities, and trading will likely go to perps and or just stay in TradFi, especially, if they're competing with 24/5 or whatever it is, overnight trading. I suspect even perps might struggle short term with that.
So why has trading been the first product? Is it because the parties providing tokenized equities are exchanges, or parties are Robinhood and trading venues, or why? Because that seemed very obvious to me that it's not the first product you should be building, but somehow it has been.
Yeah. I like this phrase of degens being pioneers, because it's like really they test out, things that are riskier just to be able to, try to get some alpha. So it's no surprise that in the bear market, people gravitated to assets that are actually going up, and those are outside of crypto largely. So that's why I think, easy access through centralized exchanges made people consider, oh, you know what? I already own my Bitcoin here. Why can't I actually own my Tesla stock, QQQ, whatever it is, within my crypto exchange as well? And so we're seeing just the convergence of like Robinhood is now also a crypto exchange, and Kraken is now also a TradFi exchange. So that's just like fintechs converging and competing 1v1 more closely.
So Katya, is there a place should you do tokenized equities if you're gonna just do trading? Is that another way to frame the question? I mean, how important the things that you give up, governance rights and voting and all that, how important those are for trading?
It's a great question. I mean, a lot of these tokenized representations, like you have no claim to the underlying, like the legal standing and how much you actually own the underlying. I think Robinhood does the same too, right? Even not in their tokenized equity platform, in their crypto platform, like you're not actually owning the stock outright. And so you miss out on, I do think they still pay out dividends, but for the most part, you lose out on a lot of the values of owning the stocks outright. I think the reason why trading took off initially was because it was a lot of non-US people who wanted access to US equities. It's a super volatile market. It's super exciting. I think there was a lot of like global appetite for it. I don't know that trading US equities for a US audience is going to be interesting. I mean, I would love to be proven wrong, but I think the work that Tokenized is doing in becoming a transfer agent to allow the equities themselves, where the governance rights are represented, like it fully is that equity on chain. I think that is going to take a very long time for that version of tokenized equities to take off and be done right. But once it's done, I think then trading can become a much more worthwhile primitive. Then yield and all of the DeFi primitives on top of it can really hit their max potential.
So let me double click there, because this is an area that you're also spending a lot of time on. The experience, the product market fit, the experience that is the dream experience should be, I go from my Microsoft stock to more Microsoft stock.
Mm-hmm.
And tokenization just sits behind the scene. That is not the experience. Could you explain what is experience today? What do you have to do? And what is the gap?
Oh, it's terrible. Right now, if I've got my Tesla stock in my brokerage account and I wanted to access it on chain, take leverage against it, earn yield, whatever, I would have to sell that equity and buy it outright through the platform that's doing the tokenization. And so that's a taxable event on the sale process, which is very unfortunate and not quite what I want to be able to do. The key piece that's missing is being able to transfer those equities from my existing brokerage to the brokerage account of somebody who does the tokenization, but there's still some regulatory hurdles to be able to streamline that flow to minimize the tax events there. So once we can get my existing like portfolio on chain without incurring a ton of fees, that I think is going to be when yield and all these other components can become really interesting. Until then, we're still stuck with a really fragmented, siloed experience. You not only would have to sell your existing equities, but then you also have to onboard with a new platform, go through KYC. Like it's just, I think everybody in crypto is used to chewing glass, and we have the stomach and the tolerance to do that. But I don't think, the average person is ready for that experience. So if you're
that is a point that shouldn't be underestimated. Like I was having this conversation with, let's say, CEO of a top 5 exchange, and he said that all that is true, but thankfully there is enough people in crypto, there is enough of an audience that is willing to buy their equity outright, buy their Nvidia to earn yield on their equity, which is I said, yeah, it's in the hundreds of millions today, and that should be probably more than enough to validate the initial use case.
I mean, I'm happy for those who are willing to do that, but like, it's like a fallacy that the industry has had for many years. It's the build it and they will come. Like just because we have been able to prove out that there's some demand for tokenized equities on chain, I don't think that's like, retail product market fit. Like the average, my father is not going to be the one that's going to go through that process and tolerate the pain and additional fees associated with it to do it on chain just because it's cool, right? So I think there's a lot of, I think more than anything, this painful process has identified the gaps in the flow that, 2 years ago, nobody was thinking about solving. And now we can start to work towards building out that streamlined process.
Yeah. All right. So let's before we go to the final section. So we discussed treasuries at their momentum, credit super boring, money market funds is whatever, tokenized equities is exciting. Now let's talk about the future. So what are new RWAs that I think could unlock the potential of this space? So in particular, there are 2 areas on the periphery of it that I've been studying a lot. We have been having a lot of debates internally that are compute, what is triggered by AI, and energy, right? There is an entire renaissance. The golden era of debt financing is happening now with deals around GPU compute. There is a lot of things happening on energy. There is all around the expansion of AI capabilities, which is a topic very close to our hearts here. Obviously, a lot of those deals are big and long cycles, but you're already starting to see CLOs and product wrappers around this in the market. So what could be, Lucas, let's go to you first. Like what could be a future of this? Now we have tokens that are like AI tokens, right? That are value. You have GPU cycles. People are leasing GPUs for 2 years. They might want to hedge that exposure. How can that work in DeFi?
Yeah, that's a space that I think has had some friction. But you see like a lot of demand to get credit against compute and like GPUs, but really there's a bit of an adverse selection problem right now with crypto where you can access loans, but probably for the lower quality borrowers, whereas TradFi is already pouring in hundreds of billions into partnerships with NVIDIA and providing credit against those. So I frankly don't know exactly how you surpass that adverse selection problem just with a much more illiquid market. You would suspect that eventually it can gain some liquidity and try to compete at like lower rates, especially if you can source capital for cheap in DeFi, which has been the case recently. But you would also need to find a way to, find the credit quality and like access better creditors than just the cheap ones that are not interested in.
Obviously, I don't have a solution to the problem because if I had, I would be working on that because I think it's the opportunity is massive. But here are some principles. So Jensen Huang did this press release last week with the CEOs of five financial entities that they announced a 500 billion fun, but the whole thesis is that the AI factor is an investable asset now and how it accrues value and all this thing. A lot of the GPUs, the lifetime is 7-8 years now, longer than anybody anticipated. Crypto is amazing at capital formation. Like we invent capital for every other stupid thing in the world. Why couldn't like to think, because you see the OpenAIs, Anthropics, all those deals, but there is a second and third and fourth tier companies that are also getting deals done that are massive deals that I think for that demographic crypto capital formation could be interesting in DeFi. The second thing is energy, like nuclear fusion, fission, solar, space, right? Like I think all this stuff is just going to unlock a new. So if we think DeFi is the future of finance, right, particularly debt financing, in credit, like shouldn't it play a role in this new credit cycle? Katia?
Lucas, do you have any thoughts on it? I haven't spent much time thinking through this.
So I think it does have a role, but it's part of like the growing pains of having to bridge the TradFi world on chain, where you really need to be able to have oracles and like all of the data that's off chain properly tracked on chain so that it can be programmable the same way that current DeFi native assets are. So I think it will be done. I imagine maybe 3 years to go on that, even though the early experiments are happening. But it's just a matter of like having a lot of these things plug in on chain and have
or the future of finance, I can only finance a pass type of thing.
No, I mean finance the assets that are structured for the future. So if it's like just a bridge of the existing asset, it will be worse. And I think there's enough appetite that's already lending to these opportunities in the real world that unfortunately DeFi is too small to compete and it has too many frictions to compete currently. But I think there will be one or two pioneers that find a way to be able to track all of these metrics and make it programmable, and eventually that will lead to like lower risk in the system and lower rates, and also be able to plug in to the more source of capital, which, as you say, Jesus, is like the real benefit, or at least the most used benefit every crypto cycle is just fundraising in a different form. So I think we'll get there, but
yeah. All right, let me do 2-3 rapid fire questions, just yes and no answer, and maybe a brief explanation. So do RWAs require a new chain? Like we have seen attempts to that. Do we need new blockchains for RWAs? I mean, those have existed or exist still, I think.
No, God, no. I think I not only think that we don't need new blockchains for tokenized assets, I don't think we need new chains, period. I think we're good. We've built the necessary infrastructure. There's sufficient blockchain engineers working on improving the stacks that we have. Don't need any more.
But what are all of those token investors gonna do if we don't launch new chains?
Who's touching tokens anymore? Seriously, like you look at the trading activity. Yes, there's a little bit of meme coin activity, but generally, like protocol token volumes are gone.
Okay. So Lucas, do we need RWA specialized chains?
I mean, only if you have like a very unique distribution that the chain provider can build. It's the only case that I can think of. Otherwise, Solana and Ethereum are quite solid enough.
Okay. So let one level of granularity, abstraction up. Do we need RWA specialized protocols like, the Aave Horizon Play, like those type of things that are specialized for the RWA use case?
That makes a bit more sense, yes. Just because the risk management and the levers that you have access to is different for an RWA than a DeFi native asset.
Kathy?
Yeah, I mean, I think that the infrastructure that's live today is robust enough to allow us to continue to scale these RWA use cases. If there's some very bespoke solution that needs some specific contract to be built, I don't know that you need a brand new protocol for it. I think what we have on chain is generalizable enough.
All right, so to close it out, and look, we're partners with every RWA provider over the sun, so I don't think anybody's gonna get offended with this, but name one RWA that has no business in DeFi.
There's the KKR asset that I think Securitized issued many years ago.
And why? I mean, say why.
It's a multi-year lockup, super illiquid, very difficult to exit. I think it was an exciting time to have KKR on chain, but the asset itself was just not usable, and now at this point is more dead weight on the books than practical.
Lucas?
Agreed. Frankly, I think we'll try those again in the future, but not apt for the current DeFi.
You need to name a different one. There is plenty. Like, I mean, I can give you 10 if you want.
Name a different version of long lockup private credit fund. I forget the tickers as well, so there's many of them.
Okay. Wait to answer like a true politician. So, all right, so we can go to Q&A quickly. You can use the Q&A panel if you want. So Diego said, how do you tell the difference between an RWA that is truly DeFi versus one that is not useful? Oh, this is cool. We can, I think we answered that, right? Lucas, do you want to take it quickly?
Yeah, to a certain extent. It has to do with the liquidity for the asset, the price feeds that you can access, ideally 24/7 or 24/5, and the redemption also related to the liquidity of being able to unwind quickly so that people are not just stuck in positions there.
Great. And then Donna said, how much of the progress is impacted by the SEC? That was negatively, of course. So no, I'm kidding. Like, Katya, do you want to? We had a chat with the SEC recently, so.
We did. I mean, I will say that the current administration is very open to having honest conversations around rules and regulations and like rules of the road for tokenization. I think nobody was surprised by the recent statements made by Pierce. Like, if it's a security off chain, it's going to be a security on chain. So anybody who was surprised by the announcement probably hasn't been following the markets too closely. I think the more guidance and more clarity from the SEC will always push us in the right direction. I think they haven't been too detrimental to innovation, though, so long as we're able to continue to experiment without harming, regular investors.
Cool. And then Bruce, is not much of a question. I think he's saying that he agrees with the future of solar, wind, and other things, but solving liquidity is a problem. Yeah, I'm afraid this is starting to have a flavor of the 2008, 2009, where you're raising derivative of these loans that are more liquid and things like that. And I think the tokenization of those is going to be interesting. So I hope it happens. Like, I think DeFi should have a play in that new market. I think there are no more questions, so we're right on time. So thank you very much to everyone who joined. The next webinar, I don't know what it's going to be, but it's going to be about insurance in DeFi, of course. Some big announcements there, so sign up. The link is on the bottom. And